have been reasonably volatile. Of course, it's a little contrarian if you look at the Indian markets. While, others were going up, we are at a point where we are doing relatively well. So let's go through and go through the session, and I'll share my thoughts, and we'll try to keep my part a little short so that we can take sufficient questions at the end. Yeah. So where are markets today, and where do we stand, right? So the next few slides is about how we shift through the markets right now, and starting off with we've seen a lot of geopolitical tensions right from I think I just did a snapshot of some of the news, and this is what it is, whether it's Russia, whether it's Iran. You have a lot of geopolitical tensions happening, and also spreading at a rapid pace. So what is it that you do while there's so much of geopolitical things going on, right? The Sensex also continues to be seeing a lot of volatility. So if you see right from 2025, you can see the ups and downs, and it's all evident from this particular chart. And even with respect to the US-Iran ceasefire and then ceasefire breach, and so life has got very interesting. And if you look at the Sensex, we are actually lower than the peaks that we have seen in the past. Uh, Now, if we thought that only Indian markets are uh, been volatile, it's also seen globally as well. So if we come back and see the returns for the financial year, okay, uh, India suddenly has come up a bit, right? But if you saw the 1 year return, we are actually right at the bottom, okay. So you found the Kospi, which is the Korean index, actually on a 1 year basis moving up 111%. Okay. The Nikkei, which is Japan, had actually done almost like 58%. Okay. So you're finding that even other emerging markets like Brazil, even the overall emerging market basket of MSCI, okay, had gone up, 33% in the last 1 year, but India was negative. Now, interestingly, I also have a chart saying that what happened in the last few months. Okay, and even with the Kospi, where some of these markets went, things have been reasonably volatile, and that is what we have here, right? So if you see the Nasdaq, which are doing really well, has been sideways almost like since May, and it went up and then also saw a reasonably steep correction before some pullback right now. Uh, if we went back to the Korean index, which is on the left bottom hand chart, you will basically find it is still very much down from the peak that we saw somewhere, in June. And from almost like 9,200, you can see that it came all the way to 5,600. So steep fall. That is despite this, you saw 111%. So which means that the gain was so steep, and even though the fall has been there, we are still seeing that on a 1 year basis, it has been decent. Now, again, some of our favorites of the previous year, okay, which is gold, and everybody thought it was running away, and even more about silver. There was a bit of a FOMO type of a situation that happened, including people buying physical silver, etc. So things have been very, very volatile, right? In all of this, it's very interesting that if you see, the Indian markets have moved up, okay, from March to July end, okay. And if you saw, interestingly, the mid and small caps which were very volatile, prior to March, ended up actually, doing very, very well and going up almost like 30%. So if you see, interestingly, on the right hand table that you have, the corrections that we saw, what we saw called as drawdown or the peak to the bottom, okay, in the case of small caps was 26% almost. Okay, and if you saw mid cap, which did very well in the previous period, actually ended up falling 22% and Sensex almost like 16%. Okay, what was interesting there is the recovery from the bottom, which is the next row, right? While the Sensex only moved up 6.3%, which is why it is lower than its peak. Okay, the mid cap index has just about crossed it, and the small cap index, or got a higher return. Now, what may happen is, even though the small cap return, looks like 30%, and the mid cap return looks like 23%, and it looks higher, you must keep in mind that from the peak, a 22% and a recovery from a bottom need not be the same. Because let me give you an example. Say if 100 rupees, say, went to 150 rupees, it's a 50% fall, right? But on 150 rupees, if you saw a 50% fall on 150 rupees, right, it is much higher, right? So that's the point that one is making, that from a market which is peaked, the fall is higher, and the recovery need not be the similar one. But that is something that you keep in mind. Okay. The first quarter, of course, has been very, very good. So you'll find that the first quarter delivered almost like 29%, okay, type of returns, and mid cap also has had recovered, and gone up 17%, whereas the Sensex, as you can see, even from the bottom as well as from now, it's sort of the same. Okay, so the point I'm making is, you have a lot of global volatility. You have markets which are doing very well. All the AI stocks, all basically Nasdaq, Kospi, which is Korea, etc., which did well, come down. Of course, there's been a much larger fall for gold and silver. Okay, see, and all of that we've seen Indian markets do reasonably well. So as usual, I had my survey for you and saying that, where do you see the Nifty end, at the financial year? Okay, from here. And do you think it'll grow by 15%? Do you think it'll fall 10%? Or do you think it'll be range bound? Okay. By range bound, I'm saying -10 to +15. Okay, so Tara, if you can share the survey.
Yes, sir.
Yeah, we'll give a few more seconds for people to complete their participation in the survey. Okay, so here we are, almost like, so if you see, it's interesting. People feel that almost like 46% of people feel that it'll grow by 15%, and another 46% feel that, it'll be range bound. There are not too many naysayers right now. Okay, so we have only about 8% of the people feel it'll fall more than 10%. That's interesting because, you know, India has been contrarian and it's gone up while other markets have sort of corrected. Okay, and some of them which did very, very strongly. In some form, we saw that, if you saw the 1 year return, India was probably a bad name, okay, and not moving up while every other market moved up. Okay, but right now, despite the move, we are reasonably bullish, or we believe at least it will be sideways. Thank you for sharing your results, your views. Okay, coming back to now, the point is, I think for all of us, where do we go from here? And I always like to go back from history and past cycles and what are the learnings that we can get. And I also like to look at it, in terms of raw data, and because data teaches us a lot. I think one of it was, and interestingly, we also gave out a bullish call, right from February onwards, saying that we think markets will likely to do well. Okay, despite being through the war and all of it. And one of the reasons was this, that you know, typically people felt that crude oil is going to impact. So we said, okay, let's look at uh, any crude oil move which was higher than 40%, and what happened to the index, let's say 6 months from here, or 24 months from there, right? So what was interesting to note was actually there is a short-term correlation. Okay, so maybe in the short term you saw some bit of volatility, but because if you saw 3 months, you found, 3 months from the Gulf War, you found a 24% fall. Similarly, in Feb 2008, post that, you saw 32, in that period, you saw a 32% fall. Okay, and there are other periods where you saw 5 and 10%. So, of course, there were some periods where within 3 months itself, you found, the Sensex come back. But what is very clear is right from, if you saw something like 12 months, okay, it has not been linked to actually the index. So what we call it as, it was not been correlated. I don't want to say that, oil's price spike will, result in a 1 year great return. Okay, it depends on what are the factors that are driving it at that point of time. Okay, so that is something that we will go through today and see what are the factors that are driving us from here, and what do we think and where do we believe we will be, right? So one point is that we are learning from the past is, crude oil price shocks not necessarily impact in the, long term. Okay. Similarly, if we look at much shorter terms for, wars, and we found that those have even shorter, time frames, so which is where we said, let's even look at, 2 months return, or 3 months return from the bottom. Okay, what was interesting is, I mean, wars are, have been less correlated, and possibly wars have actually have a positive impact. Okay, so what happens is that typically you will find that uh, there'll be a lot of destruction, unfortunately, but then there's a rebuilding that comes in, and that, at least economically, because of the spending, that also creates a bit of a spike. Okay, but some of it, of course, may not be linked to the war itself. It may be more about natural, how the economy is doing and other factors, rather than it being impacted. Because I'm just saying, for example, an Iraq war would not have resulted in a spending benefit for India, right? So some of them may not be related to India, including the Russia-Ukraine conflict, etc. But the point I'm trying to make is that there is no long-term impact of wars. Okay, so which is what, kept us bullish at that point of time when markets had fallen and valuations had come down. Okay, so what are the opportunities and risks? I think the opportunity is, there have been a lot of positives for India, right from, there's some stabilization that we can see in the US-India FTA. Of course, I think till it is signed, there's always, some bit of volatility out there, and some bit of uncertainty around the deal construct as well. Because what happens is, there's a lot of negotiation that's happening, right? Actually, including on the war between the Iran and the US, right? Some of these things are all, some of the steps and of the hits and stuff, all are intended to, get an upper hand on negotiations, right? So that is the, point of it. So that till it is signed, there will always be some bit of uncertainty around those particular areas. But I think what has happened for India is, we moved on, right? So, and what we have done, in fact, I believe it's a very good thing that has happened, because it was a wake up call for us. Okay, we have gone and done a lot of free trade agreements with many other, countries out there, and that has been, that will be positive for India in the long term, right? There was a renewed vigor to do some of this, which may not have been there in the past. And the policy stability has been reasonably good, and there are a lot of things happening for MSMEs and infrastructure, and there's a lot of investments happening in the Eastern Corridor. Okay, all of these will only, help the economy. RBI at a very timely basis sort of stepped in and provided liquidity support. Okay, they also came and stabilized the rupee at some point of time. Okay, and so those are all, been positive impacts for us. Earnings and valuations, we'll share data. I think that has been very, very positive. In fact, this is one of the most positive aspect that we can see, because in the end, closest to equity market returns is what is happening on earnings or profit growth. Okay, and that will cover a little bit more detail as we go forward. And government capex, continues to be positive. Now, what's interesting is from the other side, if you want to see how the economy is actually doing, I think indicators like, bank credit growth is very, very positive, because this is not government coming back and doing something, right? So it is companies going back and beginning to borrow again. And typically you do that when you think that, things are stabilizing and you start investing in new projects, etc. And that is reasonably positive for us. So you will find that in periods, typically, there's a positive correlation between, credit growth and, market growth, because what happens is that growth in spending, etc., only continues to come and boost the economy. Okay. Now, what is it happening in terms of earnings? And I think this is a positive one. See, I was suggesting that in the long term, you'll find that earnings, which is profit growth, and the market, which is, let's say, the Nifty 500, which we've taken here, are follow a similar trend. When they diverge, okay, they are opportunities for us. So what had happened in March 26 is you found that it diverged, which basically means that by the price we are talking about, the index, Nifty 500 index, okay, had corrected, gone flat, etc., etc., up to March, while the earnings per share ended up growing for these particular companies. Okay, so what it meant, and what kept us bullish was that we believe that this will ensure that there will be a spike in markets to sort of come back towards the trend in earnings. Okay. Uh, Now, if you the other positive which is interesting is, a lot of people were coming back and saying, no, no, but FIs are continuing to pull out money. And one of my points, and also covered that in a bit of a LinkedIn post of mine, is was that whenever you find FI selling at an extreme, actually it's a buy indicator. Okay, why? Because they will reverse it at some point of time, and it's a very, very known trend. Of course, it's very difficult to predict the exact timing, but we saw that there has been very, very significant FI selling, and we felt that was also positive. Okay, now in the month of July, you found FI is actually pumping 20,000 crores. Okay, in July, but more interesting than that is that they went beyond large caps. In the past, FIs have always invested only in large cap companies. Okay, but this time, if you see the number of companies where their holding was greater than 1%, okay, actually, skyrocketed. Okay, while interestingly, in the period up to last month, you found that the FPIs, or the portfolio investments of the FIs, actually ended up going down. So what is interesting is, they were selling some of the large caps, and partially they were investing back into mid caps and small caps. Okay, and that's another positive trigger for us, and possibly if that continues, that will continue to keep this mid and small cap index positive. The other interesting data point that we were looking at is to say where are the opportunities and what are we learning from, is actually we studied the US presidential cycle. Okay, what data threw up to us was actually staggering. That if you went and saw the pre-election year or the year three, which is after the midterms, okay, you found that the average return is 30.5%. Okay, so across multiple terms. So that is very, very interesting data. And so that also gives us a thing that the outlook, post November, okay, hopefully should turn positive for the US as well. Okay, now coming back to earnings and valuations. Okay, so how
Sir,
is it?
just a minute. Can you please restart your camera? It is completely off. You are not visible. Presentation is visible, but you are completely off.
Okay, 1 minute. Okay, can you see me now? It's good that people want to see me as
Yes.
well, not just the
Yes.
PPT.
Yes.
Okay. Okay, good, thank you. Uh, so coming to earnings and valuations, okay, you will basically find that this is very, very positive. If you see the first quarter of 27, okay, the earnings so far, you would find that, large cap earnings, has been reasonably weak. Okay. And of course, if we set aside, the oil marketing companies or the OMCs, right? And why you set aside the OMCs? Because they are impacted by an event, which is the war, right? What is interesting at the underlying, if you leave that aside, is large caps are growing almost like 14%. Okay. And you are also finding that mid caps are growing at say 20% in terms of profit growth, or what we call as earnings growth. And small caps, interestingly, are growing at 27%. Okay. And you will find that across sectors, also it has been sort of reasonably interesting, which is also giving us the confidence, right? We are likely to see, markets also continue to maintain steam. Now, the other part of it is about valuations. So if you look at, the current P, and you look at a 5-year median P, you may come back and say that, okay, you know what, small caps are looking costly. But if you keep in mind the growth in earnings that they are seeing, right, you may basically find that the denominator, basically the earnings, is growing well, and that will probably ensure that small caps continue to do well. Of course, you must keep in mind that when you look at small cap cycles, they see larger swings. So for the Nifty, typically, around 20 is a reasonably good time to buy. Okay, and typically, around 28, 29 is a good time to sell. But in the small cap index, you'll probably see, the peak can even be like 50x. Okay. So if you go by past data, whenever it trends, small cap index can do reasonably well. Now we are looking at small caps in another way. We are saying that, okay, considering that the earnings growth is likely to be good, okay, what we call as on a 1 year forward PE, which means if you look at earnings for 1 year and then you see what is the PE, on that basis, is what we are. And if you go by that, you'll find that earnings are reasonably good on a 1 year forward PE basis, and they are lesser than the average. Okay. And because future earnings is what drives market performance rather than the past. Okay, we believe that this is a good indicator to look at, and also substantiates a point that we'll probably see continued PE expansion for the small caps. Okay, and of course this is a chart that we have regularly come back and shared, is that this gives us the alpha of small caps versus, let's say, a large cap index. So basically, we'll see the small cap index 1 year return, and we'll minus the large cap index 1 year return, and the differential is what we see, which is what we call as alpha. Okay, which is how much better the small cap index is doing over the large cap index. And what was interesting is to 2024, you found that it was 40%. Okay, and so typically, which is +1 standard deviation, and it was actually a muted rally for small caps, because if you see in the past, okay, so this has been much higher. Like in 21, it had all gone to almost like 60%. In 2014, 13, 14, 14, actually, it had gone to almost like 60%. But if you went at almost like 2009, it had gone to almost like 80% and 120%. So if we go by that basis, the last rally was a muted one. But what again gave us the confidence that small caps would come back is when we looked at it, it from the top, hitting the red line, it plus one standard deviation, it went to the minus one standard deviation. And that sort of also gave us the confidence that we were closer to the bottom. In fact, for us, what we did is we also rejigged our portfolios on that basis to be able to take advantage of the next rally, and results were very, very good for our strategies. And so if you see year to date, let's see our super value, which is a mid and small cap portfolio, actually ended up growing 35%. Okay, of course it saw some volatility because small caps did see volatility in the previous year, but just from April to date, we have a clean 35% type of return. Okay, and so one is to look at the opportunities, but what are the risks as well, right? So one, some of the risk factors that we always need to look at is corporate earnings. We think the risk is very low because earnings continue to be strong, right? So similarly, domestic flows, because of SIPs, you know, that we think will likely to be continue to be good because SIPs are contracted type of investments. So for it to stop, people have to physically, go and stop their SIP, which we think is a bit of a less likely one. So the risk there is low. AI related sell-off, yes, we've seen some of it, but we think that markets are factored in, and we are not expecting a high impact there. The India-US trade deal, like I said, okay, there's so much of time that has gone by that I think whoever to change, their value chains, and the supply chains have already done most of it. Okay, what we think can impact it on a higher basis is, geopolitical. And why does that happen? Because of oil spikes. See, the point is, uh, when oil is say below 100, it's not so much of a concern. And we've seen in the past that when oil does well, actually Indian markets do well. Okay, why does it happen? That's because when oil does well, it means the global economy is doing well, and there's demand for oil because of that. Okay. Uh, when there spikes beyond a point, it starts impacting companies. Okay. So, which is why when it crosses 100, always in the past, it has impacted in some form. Okay. So that is something that we see as a moderate risk, and linked to that, the oil, price volatility that is coming out of it. So that we see as a bit of a thing. Yes, in the medium term, we believe that, AI related sell-off can become larger. Okay, but we don't think that the AI story is over yet. Okay. One of the other near-term risks that we saw was the rupee, which was depreciating, and we believe we are also, we had given a call that we expect the rupee to peak out at closer to 100, and that's a little below 100. It's so far it has come down, and rupee has appreciated from there. We continue to believe that rupee will appreciate on a say 2-year basis. Okay. Now, so what is it that we are looking at in terms of, what should one do, right? Because in the end, okay, now we looked at what is happening, and what are the parameters that is likely to drive markets up, or what are the risks that we are likely to see. But what is it one should be doing right now? One is we are talking about portfolio positioning, which means we are saying that why should one invest? Because in the previous 6 months, everybody was suggesting, okay, go and invest globally, right? So we believe that India is likely to do well, including the Nifty. We think will sort of come up and do well as we go forward. Uh, Global equity, at the same time, we continue to be positive on. So we think you can diversify. Of course, there we believe that the rupee, the benefit that investors got earlier from rupee depreciation, at least if you're based out of India and you invest globally, okay, that in my view is sort of going to go away. Okay, so the second part of it is, okay, the previous year everybody was looking to invest in precious metals, and it was doing very, very well. Especially silver was saw a very steep spike. Okay, so we believe, in fact, we gave it a call that we thought, equity will do better than, precious metals. And we continue to believe that way. But from here, we may see a rebound of precious metals at some point of time. Okay, so that is something which is sort of likely to be there. Of course, we've seen some, initial turnaround in the recent days, and we need to see whether that sustains. Okay. The large caps versus small caps and mid caps, we think in fact, this time in our quarterly report to clients, for example, on a market view, we have said that we are bullish on all. Okay. So, large, mid, and small caps, we are bullish. Of course, we believe that small caps are likely to outperform, but I think there will be a period because of lower valuations and a PE re-rating on large caps. We think that large caps also will come back and do well, on, let's say, a 1 to 2 year basis. Okay, the other one is gold versus silver. See, gold is, let's say, it's like portfolio insurance, okay, because gold is seen as a hedge against volatility on a global basis, okay. Secondly, central banks, are also use it as like a reserve, right? So from that standpoint, gold, because a lot of move away from the U.S. Treasury bonds towards gold, and we think that in the short term, because of volatility, you may find that, and especially currency, etc., one may find that dollar and U.S. Treasuries, were doing well, but we believe that over a period of time, gold will come back, and central banks will come back and restart and increase their investments into gold. So that will do well from a hedge against markets. Silver, in our view, is a high risk, high return type of investment. It's more by consumption, and we think that will also pull back. And we are also possibly at the last leg of the correction that we've seen in silver. AI themes versus consumption, etc. We have a bit of a global strategy of fund of funds that we sort of run, and there we have been active between AI and consumption. Interestingly, over the last few days, we sort of increased back our allocation, to AI in the portfolio, and that has done well. On a prior basis, we sort of book profits out of the AI theme. Okay, so that is something that is there. I think consumption will continue to be a stable type of return there. So what is it that one is saying? Okay, in summary, yes, volatility is cyclical. You will find that geopolitical shocks are there, and it will trigger sometimes a very sharp correction. There may be periods when, if you look at even 3, 4 months back, there were a lot of people suggesting that, we think India will continue to underperform, right? And global investors, if you went back and saw, what was the investments flowing, like you have the MSCI index, okay, in that you found that Korea and Taiwan saw huge spikes in investments into those countries, okay, whereas India had actually come down reasonably much, okay. And those are the points and where it turns around, and there was no surprise for us that India sort of came back and came back strongly. Of course, from here we think that AI team also should do reasonably well, and India should also do well. Okay, so the fundamentals for investing in India are very positive, and the most important, like I said, was earnings growth. The other indicators which sort of give us comfort, like credit growth of banks, okay, and valuations, after the fall, or after a sideways market, because earnings continue to do well, right? And we think that mid and small caps will continue to do well. In fact, one of the things that we did, in a contrarian basis, we launched our AIF, and when we started filing, we had to start filing end of late calendar year, last calendar year, and So by the time we sort of got approvals and we launched it, okay, our view that time was, and we took a contrarian view because small caps were doing badly. But that has done very, very well for us, mid and small caps. Okay, and we think that that will continue, and it's good for you too, because the typical cycle of mid and small caps, especially, is about anyway between average of 24 to say 30 months. Okay, uh, the FI flows are also turning positive, and that's another big, you know, uh, positive indicator for us, because where both domestic investors and FIs put money together into Indian markets, that can really fuel the Indian markets as well. But at the same time, these are initial green shoots that we see. It's just 1 month that FIs have come back, for example, and one needs to continue to watch it. Okay, and we also need to continue to watch, global markets, etc. So that is something that we will continue to look at. So we are saying that be selective and be diversified. Okay. So, by selective, we are saying if you're investing in, companies, stocks, basically, then look at it based on the quality of earnings, etc. Okay, that's something that we like to do. Okay, because that gives you margin of safety, and also, one can end up taking advantage of not only India but also global, markets, etc. So diversification, in our view, is very good for also navigating the geopolitical environment, and also to manage this. So.